Well, we're seeing a full-blown flight to quality coming through in markets. There's instability in the financials, and the banks really see traders rush into the safety of the US dollar, the Japanese yen, and also into US treasuries and defensive areas of the equity market. But with a full-blown repricing that's taken place in the rates market, it's going to make the ECB and the Fed meeting very interesting indeed. Hang on to your hats. This is a headline-driven market. This is the trade-off. Well, hi there, I'm Chris Weston, Head of Research here at Pepperstone. We're joined in 2 seconds by Blake Morrow from Forex Analytics, and we're going to be discussing all the factors what's going on in this crazy world of markets. We're all banking analysts these days, and how this is flowing through into sentiment, into markets. I say that with a pinch of salt, and I'm going to bring in the great man, Mr. Blake Morrow. I love the tan. I'm loving the tan. Is this like a thing that you've done with fake tan just before the ECB meeting because Christine Lagarde? Blake, you're looking very, very well indeed. Where have you been?
Well, first of all, this isn't fake, and yes, it was for Christine Lagarde in light of tomorrow's ECB meeting. But I happen to be in a very sunny place that I did not take sunglasses off, nor did I put sunblock on. So this is.
Where'd you go? In the Bahamas or?
No, it's next door in Las Vegas, Nevada, for a soccer tournament for football. Sorry, excuse me.
I love
football.
that. We would do anything to get it past the wife, won't we? Soccer tournament.
Yeah, that's right. So, what happened to the bank account? Don't mind that. Don't mind.
Yeah, don't worry. Took the kids out for burgers afterwards. Anyway, look, we could chat all the day long about Vegas. We've got some good stories on that one. But
Yes.
Let's go into the markets because there's a lot going on right now. So let's go into topical thunder. Sentiment, my dear boy. Well, let's talk about sentiment because right now, as I talked about in the synopsis, we are seeing a full-blown flight to quality. And that could materially change. Let's see what happens with the ECB and ultimately the Fed meeting next week, which we have to discuss in great depth now because there's going to be some binary trading opportunities that arise as a result of that. But if I have a look at the markets right now, obviously we've seen this big drawdown in treasuries. We've seen some outrageous volatility in the interest rate markets. We've just seen, SOFR for the June contract. This is the secured funding markets, interest rate tradable markets, and they traded in 107 tick range. At one stage, the CME had to actually take them offline for 2 minutes because they traded 50 ticks in like an hour or so. It was just outrageous. We saw 64 basis point range in twos, and German bunds have just been absolutely smoked in terms of yields going lower, price obviously rallying. We saw the VIX trading to 30%. We're all watching these kind of liquidity measures and dollar funding measures. A lot of people have said that the banking issues is a storm in a teacup. I'm not so sure that that's the case, and I'm pretty cautious about that. It's definitely a risk that we have to manage. So how are you seeing sentiment at the moment? Are you feeling a bias towards dollars and these kind of quality assets at the moment?
Well, okay. So first of all, I love that storm in a teacup. That's a great analogy there. But I do want to say that with the move that you saw on the short end today, at one point, 2-year yields in the U.S. were up over 10%. That's telling you something. When you say flight to safety, everybody's running towards treasuries, even though debt might be the issue at hand, everybody still runs to treasuries no matter what. So especially U.S. treasuries, especially the short end, that really suggests that people are worried near term. The dollar. Yeah, we saw a lot of strength in the dollar because the euro really came under pressure as, Credit Suisse is a European problem. A lot of people are wondering about the exposure around, the Eurozone that CS might have. But the dollar did not see that all the way around. We saw the yen strengthen. So the yen strengthened as well against not only the dollar, but it actually strengthened against other currencies. We saw the Swiss franc. One of my colleagues said it might be some repatriation flows, pulled back towards the end of the day as some headlines came about Credit Suisse. But overall, you're seeing even the safe havens in currencies start to make a move. So I think that warrants attention. I don't think you saw a huge response in the Aussie, the Kiwi, the sterling today because there were so many euro crosses getting absolutely destroyed. but that doesn't mean that's going to last, right, Chris?
I just want to say this before we go on to the next subject. What's a really interesting thing? We're not seeing that outrageous panic. Just sell everything, because what we've actually seen is as bond yields have been falling, there's been this rotation in the equity market out of energy. Obviously, oil was smacked. You've got some charts on that later. We've seen financials obviously under pressure. But there's been this rotation into tech. There's been a rotation into utilities, into staples, into communication services. So we haven't had that chuck the baby out of the bathwater, which is one of the worst sayings ever. But we haven't had that outrageous sell everything kind of moment or buy treasuries because there's been this rotation in the equity market into quality. And that, to me, is some sort of a reassuring situation that because bond yields have been falling, people still want to own equity, but the right type of equity. And right now that's long duration assets, tech, quality tech, and also those predictable cash flows in the equity market. That may change if this banking situation becomes more problematic. But right now there's just some trades that are going on, people moving into those quality areas of the market.
Moving or reallocating, I think, is a great way to put it.
Sorry, mate. Did I use the wrong word? Are you having a go? Are you telling me off? Sorry.
Well, Chris, I'd like to turn our attention to the next subject, which is about banks. And I'd like you to put your banking analyst cap on, nice. When you get an opportunity.
Where do we get one of those, by the way?
They are limited edition runs. Sorry, from 7 years ago. Regardless, I want to talk a little bit about the banking situation, Chris, because when you're discussing banks, what happened in the Silicon Valley Bank, what happened then in Credit Suisse overnight, two separate situations. And, a lot of people point the finger at, SVB, that over the weekend, Silicon Valley Bank, about maybe the way it was hedging its exposure or not hedging exposure, if you will, over leveraging one, how do I want to put it? One basically asset class, you could put it that way. So they are very heavy one-sided. It's kind of just being lopsided. I don't think it was a very well-run bank, just based on what I've read, from a risk management standpoint. So yeah, you could brush that off. But then today or overnight, you had one of the Saudi banks or biggest backers of Credit Suisse says, hey, basically, we're not funding you money. First of all, I didn't know that they were being funded money because I didn't have my bank analyst cap on. But
you should have.
I should have.
You should have had it on in Vegas as well. You get the suntan lines going on.
I probably should have. But that, with that being said, when there's smoke, there's fire most of the times, right? So what tipped the Saudi bank and the backers off to say, hey, listen, we don't want to continue to fund?
Well, that's easy.
Well, then I want you to talk a little bit about it because this is what we worry about, right? As traders and investors, like, oh my gosh, what's around the corner? So what are your thoughts here, Chris?
Well, I think the Saudis, they can't fund anymore. They can't increase their position because if they take it any higher, then they get over the 10% threshold and there's regulatory issues that take place there. So obviously they don't want to see their equity diluted. They don't want to see their position go down. But I don't think they can actually fund the company and increase that allocation anymore because of regulatory issues coming through. I think the thing with Credit Suisse is now they're going to get liquidity from the Swiss National Bank. I think that's pretty clear that that's going to have to happen. I think a lot of people have talked about UBS potentially coming on the bid, but I think the strike price for UBS is far lower than where we are at the moment. I think that the problem is with a lot of these banks, and certainly we saw that from Silicon Valley, is that they house a lot of these assets, these quality assets in their HTM portfolio, their held to maturity portfolio, which means that they don't have to market the losses on a real-time basis or a daily basis, and therefore you don't know where that's going to be. But also they're just not allowed in that book to hedge that interest rate exposure. They can hedge their currency risk, but that's really kind of where the duration mismatch has taken place. So I think ultimately depositors around the world in these banks are going to have to pay more for that. And I think there's going to be higher regulation that takes place. I think that's where we are. So in Europe with Credit Suisse, everyone's wondering, what happens if these guys fail? What does it mean for the knock-on effects in SocGen, some of the European banks and all the other factors? I think in the US, it's a slightly different issue. And I think we're saying there's going to have to be increased regulation that's going to take place, and that's going to see lower levels of credit being installed. It's going to be pain on the depositors more there, and that's going to weigh on economics as well, and that still needs to feed through. So there's still more to play out in this one, and we're just watching headlines as we speak on a daily basis. And Blake, that takes us really nicely into the FOMC, because you've got a situation now where we've got 12 basis points of tightening after this repricing that we talked about in the rates market. We've got 12 basis points being priced for next week's, for this coming meeting, which gives you pretty much a coin toss. So there's going to be some volatility. Question to you, just hear me out. Do they pause or do they go 25 basis points? So that's the first question to you. I've got another question, so let's keep it brief. Pause or do they go 25 basis points?
They're going to go 25.
I agree. I mean, Larry Summers, he's got his critics, but I think he nailed it for me when he said if they go on pause, they're going to send shockwaves, that they're genuinely concerned about what they're seeing. And I think the Fed, for me, they react to what they know. They know more than what we do. They've got a million people, PhDs. People are going to have a go at me about saying that, but they're in this period of change, right? But I think the Fed, for me, they react to what they know rather than trying to model what could be, and this is very difficult to model. So they'd want to see some fallout from the banking instability before they pause, and that may happen in the May meeting. But for me, they go 25 basis points and say that they're looking at this situation. The second thing, which I think is really, really, really important, Blake, is these dot plot projections. Now, I know the Fed downplay them, but look, what have we got? We've got the Fed funds, so we've got the swaps market pricing the effective rate at 3.86 by the end of next year. By the end of this year, sorry. And we've got the Fed dot plot for currently sitting at 5.12%. That's a massive divergence. The market is saying, you come to us, you come down here, come down to here. I think they're pricing 100 basis points of cuts from the May meeting effectively in the current situation. The market is saying we're going to see the Fed funds rate, effective rate, at 3.86 by the end of the year. We've got 5.12. Something needs to change. If the Fed don't change their dots and bring them much lower at this meeting to where market pricing is, that dollar's going to rally strongly. How are you looking at that situation?
Well, and stocks are going to come down. We're going to be trading well below 3,800 if that's the case too, and that's unfortunately. I'm going to say this, that I agree that the Fed will not stop until inflation is under control. They do not want to send that message, so I 100% agree with that statement. And the dot plots aren't going to change much, because right now, what was it, 60% chance right now that the market says that the Fed doesn't even keep rates unchanged?
It's 12 basis points, so it's kind of 50-50 really. So it's literally. Yeah. What do they get a coin and flip it? They call that a coin toss, don't they? Something like that.
A coin toss, but regardless, Chris, I think the market is going to be caught off sides, because the Fed mandate of inflation under control is going to be their, that's what they're going to live and die by. I think so, unfortunately. And
Eric Rosengren, the ex-Fed member, talked about it last night. Said that they should go on a pause and just get a bit more clarity. But I don't think I think we're both in agreement. I think the Fed now are saying the labour market's still too hot. Okay, wages have come down. We've seen some cooling in the labour market a bit. It still warrants 25 basis points. The moves that we saw on a month-on-month basis in core inflation this week, especially in core inflation ex-shelter, it warrants a 25 basis points, and they'd say, I think they're going to do that. So I think they're going to show the market that they mean boss with inflation. I think that means the risks are for a stronger dollar. But that's the situation. Quick one before we go into gold. ECB 25 or 50?
25.
Ooh.
I think that's this saying. It's 25.
I'm gonna go 50.
If I would have been a full, there was no tan lines, I'd say 50, but there's tan lines, so we're going 25.
Okay, cool. There we go. We got a bit of disagreement. My producer's gonna love that. They want us to see her argue and hate each other. But there you go.
I disagree. They're raising rates by a full basis point. Okay, let's move it over. I'm joking. Let's move it over to gold. The reason why I want to talk about gold, whether is it shining gold we're looking at, or is it going to be dull gold that we're looking at, is that I think that the story is a bit confusing here. And this is why I'm going to reach out to you, my gold expert. But I want to know what gold is. Is it an inflation story? Is it an inverse dollar story? Is it a safe haven play? Or is it a rate story? I mean, or maybe it's a recession play. I think there's so many narratives going on with gold. Gold is kind of stuck in the water. But when you get an asset class like gold, and something that traders like you and I and everybody listening in here trade, it's going to break out of that direction, and we're going to see a surge above 2000, or we're going to see a move back below 1800. And I hear it all over the spectrum, and I'm trying to get a gauge of how to play gold in this environment. And I know you say, well, I guess if things start to get worse, gold's going to be a long play. But what are your thoughts here, Chris, with gold?
But I don't want to sit on the fence and get splinters, but I'm a bit neutral on it. And I think there's cross currents that are trying to work itself out. And until we get that situation, it's difficult. What I will say is it's good for the day traders, right? So you just choose your market environment. You're taking those lower time frames and you're working it. Is this a range trading day? Is this a mean reverting day? Is it a trending day? You can do that quite well. But as someone who's trying to predict where this is going to go, right? You've got the cross currents of what's been a rapidly falling real rate. The tips have just been falling precipitously. And that's typically very, very good for gold. But the fact is that we've seen real rates just getting absolutely decimated. But gold's found some very, very modest stability on the back of that. I would argue that move that we've been seeing in real rates should have taken us above 2,000. But at the same time, you've got the dollar, which has started to strengthen in a falling real rate environment, because what we're looking at is the difference between US real rates and German real rates and other countries and treasuries. So that's where we are. I think you've got these kind of difference in yields, which are driving the currency markets. And traditionally we'd say that big move down in real rates would be very stabilizing and actually very, very positive for gold. But then we've actually started seeing the re-emergence now of the US dollar as a thing as well. So maybe you want to be looking at gold in a weaker currency like the Australian dollar if you're looking to buy gold. I think that's probably the trade at the moment. But yeah, obviously that depends now on whether the Aussie can continue. But that's the currency we've got. Real rates, US dollar, we're not too sure.
Yeah, and Chris, I want to agree, and the reason why I wanted to bring this up is I see and I hear so many people getting so attached to their gold story. Well, you can call them a gold bug, you can call them a gold inverse bug. I don't know what that is, an inverse gold bug, but you have people that are so biased that in this type of environment, it can wreck you when there are so many cross currents. So anyway, I thought we'd talk about that tonight.
Yeah, and I think it's interesting. So again, we just come down to gold in alternative currencies. If you like gold because it's working in this environment and the real rates are going down, then but buying it in the weakest currencies, the play du jour there. Then obviously, you've got crypto, which has been working really well. I mean, we've seen a bit of sellers recently, but when we've seen gold going up, we've seen crypto going up at a far faster pace. So that's the one that the traders are liking at the moment as well. So that's an interesting.
We'll talk about that in a moment.
We'll talk about it. It's probably a good time. Let's go straight into it. Let's go to That's a Setup. Let's bring up euro dollar. Euro dollar, we've got this kind of, I want to call it a head and shoulders neckline. We've got this trend that the market just seems to be respecting at the moment. But you can see that sort of horizontal support levels that have come through. Now, for me, the primary driver of this, if you want to get funky and fundamental, has been relative rate differentials. And what we look at there, let's say take 2-year rates. And if you look at 2-year, go into TradingView and have a look at the German 2-year Treasury, BKO they call them, and look at and put it on a yield basis, and then you subtract the US 2-year yield. I think it's a US 02Y was the code off the memory. And if you just make an equation between the two, what you see is when German yields are falling at a faster pace than US Treasury yields, you typically see euro dollar fall, and that's exactly what we've seen over the last 24 hours, and it's exactly what I expect to see in the next 24 hours or going past the ECB. If German yields are falling, it means that rate pricing is coming out of the market more aggressively than what we're seeing in the US, and you're going to see euro dollar fall. But price action's kind of really all you need to know. This is the aggregation of all behaviours. I'm a seller of euro dollar on momentum and through that horizontal resistance support level that we can see, just sort of just capping off. The market's supported there all day. So that's the kind of drivers. Obviously, the ECB. I'm concerned that we do get I think the good thing about waiting for the move lower is that you've got the ECB. If we get a 25 basis point hike and the ECB say they're conditional going forward purely on data, the market's going to take that as dovish, and we're still sellers through there. I'm a seller on that basis there, but I think there's probably some uproar risk because I think there's going to be a 50 basis point hike. I haven't given you much time here, Blake, but how are you seeing this?
Well, just go back to last week's trade-off, and I was really looking for the 200-day moving average, and we're not too far away from that, are we? So I'm with you on a bearish euro call, and you're going to be seeing my euro stuff coming up here shortly. So I'm going to say I disagree. That's just for the producer's sake, but really, I do agree.
No. For me, I'm not bearish. I want to wait for the close below that horizontal support level, which probably would come on a 25 basis. I don't think a 25 basis points coming. I think 50 is, and then I'll probably offset that with a conditional saying that we're purely data dependent, we're purely financial stability dependent. But if we get that through that level, then it doesn't really matter what I think. The market is telling me what they think, and that's probably that's arguably more powerful than what I'm believing.
Well, speaking of the market telling us what it thinks, let's take a look at crude. And crude got rude today. It was rude crude as it slid through the $70 level. Everybody and their mothers, brothers, uncles, mothers, brothers, uncles, sisters, nephews, pet monkey was buying crude above 70. And it crashed through 70 and it hit 127% extension. We broke out of a triangle. There's a triple confluence of support down at 61.5, which I think ultimately is going to be the downside. So speaking of the market showing us its direction, in a recessionary environment, it looks like we are going straight into a recessionary environment the second half of this year. One of the asset classes that's just going to get kicked to the curb or kicked lower or knocked down lower is going to be crude. So that's my thoughts on crude. What do you think about this chart here, Chris?
Yeah, it's an interesting one. I mean, fundamentally, you've got both sides of the supply-demand equation working against crude at the moment. We've seen higher supply coming through. Obviously, the perception of demand, if we were to see this banking situation spill over. I mean, what's happening in the banking space, just to take it back, is doing a lot of the heavy lifting, will do a lot of the heavy lifting for the central banks. Higher deposit rates, higher regulation coming through, which means we're going to see more conservative lending practices, more reserves being put on the balance sheet. That sort of stuff means that the banks are going to do a lot of the heavy lifting and crimping demand that the central banks don't need to do. And again, that works into the crude story. So we're going to see lower demand, we're going to see weaker economics, but we're actually seeing, we heard it last night, that we're seeing increasing supply as well. And that's why we saw crude trading in a $6.91 range. Copper was weak on the session on the back of that, similar sort of thematic as well. But yeah, you've got a lot of cross currents working against it. Again, it comes down to the banking space. If you believe this is going to spill over into something much more pronounced, and we've seen that steepening of the yield curve, which is what we talked about last week. We saw that radical flattening to the point where, the market's pricked up, and then we see that sort of served up, and that's kind of where we are. Now we're seeing that radical steepening. That's usually the point where we get the recessionary situations. So we're all watching the bank. If we are going to get a recession as a result of what we're saying, I'm not predicting that, but crude will tell us that story themselves, I think. So yeah, it's a great chart, and everyone should have crude on their radar. I think it's going to be pretty telling, not just from a supply side, but also from the demand side as well. So that's an interesting one. Blake, I want to get your thoughts on Aussie yen. Let's bring up Aussie yen, please, because we're right at the bottom end of that range. Now, if I have a look at Aussie rates pricing at the moment, we're done. The RBA are not going to raise rates anymore. In fact, we're actually pricing in rate cuts now. So the RBA are done tightening according to market pricing. And that's impacted the Aussie. But what's most important is obviously the move that we've been seeing in equity markets, in the S&P and European equity markets, the move down into risk assets. And of course, the Aussie dollar works really well in that. So we've got this really big support level that we've been seeing through there. I want to know what you're seeing in the Aussie yen. Everyone loves the yen in this time of lower bond yields. The yen does very well. It validates the Bank of Japan's stance. Do you like Aussie yen lower here, Blake?
I do, and I love it below 87. That's that horizontal support that you have, Chris. Look, I'm a yen bull, and I've been a very, very loud yen bull publicly over the last couple of weeks. When the dollar yen dropped, I closed it. I've already reestablished my position, because when something drops and it's not for the reason that you originally get in for, the reason why I'm bullish yen is I'm bullish on the Kuroda Ueda changeover this next month. And so I believe that the yen's going to strengthen regardless of what's happening globally. But then you throw, fears, contagion, recession, anything else you want to throw on top of it, that all points to the Aussie yen lower. So I would, for me, as a setup, if you're really, short dollar yen, or you want to be short dollar yen, this is the kind of place where you start nibbling, and on a daily close below 87, you start, getting more aggressively short, because this way you'll have a decent cost average on the way down. So
I think you're right.
I like it.
I think through that 87 level, I mean, again, this is a setup, right? So we're just waiting for that. We're waiting for that break there. The question, of course, you've got two scenarios. Does it then etch out a new trading range, or do we actually start seeing a bear trend playing through? We don't know. Of course, we never know. We don't prophesize, we react. And that's the two things we're looking for. If it breaks through that level, we are going to, in my opinion, either establish a new trading range where you can mean revert that trading range, or it could start trending low with a momentum move down into that sort of black horizontal level down into 83. So it's a great setup for me. We're just waiting for the trade, wait for the market to push us in there, waiting for that new market environment, which we need to react to accordingly.
Yes, I agree, Chris. And I'm going to turn your attention to another setup. Well, this segment that's a setup. This is Bitcoin. Now, I hear the stories that Bitcoin is a safe haven, whatever you want to call it. It's irrelevant when you're talking about the banking sector, SVB, Credit Suisse, whoever other bank you want to throw at it. That's fine. I'll buy Bitcoin. I'm not a big buyer of that narrative. I still question. I still question what Bitcoin's role really is, and you can tell the market does too. Technically, we finally broke that massive $25,000 level. I tried to play it on the long side. It didn't work. It closed back below 25. It gave us a false breakout. One of our traders in our community, Nick, hat tip to Nick. He saw it as a megaphone pattern. You got a megaphone pattern, false breakout, that leads to lower prices. So I think this is a setup for a potential short as long as we stay below 25K. What are your thoughts here?
Yeah, it's interesting. I think the crypto bulls will probably tell you that what we've been seeing over the banking space really validates the need to have off market exchanges and actually hold the crypto in itself, because that's kind of what you're trying to take. Crypto invalidates what we've been seeing in the whole banking space and validates the need to have crypto as a payment source effectively on the blockchain. So I think that's an interesting one. But ultimately, then we've seen some negative news. Signature Bank's gone down, and there's criminal investigations that are being taken place. And again, it's a lot of murky scenes going on at the moment in that world that needs to sort itself out. But yeah, from a pure price action perspective, I think there's probably somewhat more downside than there is on the upside at this point at the moment. And yeah, I do like those patterns as well. They tend to show some good mean reversion, and we probably trade into the midway of that range as well. So it's a good setup to have there. Obviously, we're getting pretty excited there that we were going to see this potential bull run that was playing through, and we're going to see some FOMO capital. It hasn't happened, and that's pretty powerful in itself. So yeah. Put a gun to my head. I fancy this coming down to sort of mid-range of that at the moment. So an interesting one. Anyway, let's have a look at the play of the day. Like, I want to talk about volatility. I know it's not really necessarily a play of the day. I think sort of me right now is this idea about respecting the volatility in the market as well. We talked about it at the beginning of the year, this idea about being agile, being respectful of the volatility and trading like a ninja. So if we can just bring up the chart of the dollar, I just want to focus on that a second there. So what I think it's interesting now, we are seeing big volatility, certain rates, bonds. I mean, if you're trading that, then obviously then you're respecting that. We're seeing larger volatility in the FX market. It's not huge, but we are seeing more pronounced ranges playing through. And then certainly for people who are trading equity indices and crude, this is where your leverage rate needs to be. How much margin you're putting down on the position needs to be much larger. Your position size needs to be smaller. And I think that needs to be respected. So the way we're seeing in terms of volatility, do I see volatility continuing? Absolutely. This is a headline-driven market. We're watching out for headlines around Credit Suisse, around other banks failing, and that's going to keep the market volatile. What's going to happen to ECB? Did the Fed make a mistake? All these factors keep us volatility high. And it means that all those factors around your risk management have to be front and centre. If you're getting that wrong, it will hurt you. Now, what am I looking for the Fed? I do personally believe, and it sounds like Blake does as well, that we're going to get 25 basis points. A lot of people are suggesting we're not going to. I think we get Fed back. We get 25 basis points. And I also believe that the Fed are not going to come down to market pricing with those dots. And it tells me that the balance of risk for that is a stronger dollar, a sell-off in rates. When do I place that trade? That's going to be the big one. I'll probably do it just before the meeting. Again, trading over news is either for the foolhardy or it's for the very brave as well. So I'm going to be doing it in very, very small position size.
All right, that's a good play of the day. My play of the day, Chris, is going to be the Euro Kiwi ahead of the ECB. We just had a really, really poor New Zealand GDP number, popped the Euro Kiwi up. I sold into strength. I actually have a position, so I am talking my book at this point, Chris. And as I like to try to play these plays of the day, if they're setting up, but I'm getting aggressive on a breakdown below that ascending trend line, below that 50%, below the trend line, which comes in at 169. 70 or so, somewhere below there, right around, just say a daily close below 170. It's a bearish event. You can start closing below that support. I'm going to be targeting the mid 160s. So I think the Euro Kiwi has a lot of distance to come down, especially on the heels of a very dovish ECB, which I believe Chris and I happen to be in agreement on this, which isn't always the case, but it happens to be the case today. Euro Kiwi, that's my play of the day, and I'm already short. So there we go.
Good stuff. Well, I'm still going 50 basis points. I'm not going to have any positions over it, to be honest, so there's no conviction, but it sounds like you do, so fantastic. Good work for you. We'll see what happens there. But yeah, everyone out there, just good luck with your trading. Make sure you're managing that risk accordingly. Make sure you're managing that position size. You're respecting the volatility in the market. And we hope to hear from you on how you're seeing the balance of risk. And I'm sure there's going to be some big bears out there and probably some bulls as well. So let us know how you're trading the market. We always love to hear those educated comments that come through. So we'll see you next week for more of the trade-off.